recent increase in interest rates has been a cause of concern for many households.
The overnight policy rate was raised by 25 basis points to 3%.
Bank unexpectedly raised its benchmark interest rate from a historical low in a bid to tackle inflationary pressures. It raised its overnight policy rate by a quarter of a percentage point to 2% from the record.
So the difference in the trajectory of policy interest rates in Malaysia versus the US is of difference in the dynamics of inflation in Malaysia versus what it is in the US.
Hi and Assalamualaikum. My name is Nurul Afzan binti Ahmad Kamal. So today I'm gonna share what is the initiative that household can take an action to face the high interest rate. Let's start with the basic. If you borrow money, you will have to pay back a little extra to make it worthwhile for the lender. So that is what we call interest rate. Okay, the factors to consider when making assumption about consumer behavior and interest rate increase are type of consumer, the type of product services, and also the overall economic condition. Consumers of different categories may respond differently to changes in interest rate. For example, customers who are currently experiencing financial hardship may be more willing to reduce their spending, whereas consumers who have a large amount of saving may be less likely to change their spending habits. The willingness of customers to borrow can be significantly impacted by increasing interest rate. This is due to the fact that rising interest rate make borrowing money more expensive, which may decrease consumer confidence and therefore reduce of the amount of credit available. Therefore, interest rate increase can have a negative impact on the economy as they can lead to higher borrowing costs for businesses and consumers, which can lead to slower economic growth. However, there are solutions that households can adopt to mitigate the impact of interest rate increase. The first solution for household is always be prepared to face unexpected expenses. For example, medical expenses if they do not have health insurance, or car expenses if they have an old car which need to be repaired. Therefore, the household need to establish an emergency fund to avoid them from borrowing the money. An emergency fund is a saving account that they can use to pay for unexpected expenses, and they need at least to have 3 to 6 worth of living expenses in their emergency fund, and they need to save the emergency fund in a different account, so this will make it easier for them to resist the urge to spend the money. The earlier the household begin to save, the more time their fund has to grow. Even if they can just save a small amount each month, it will add up over time. Secondly, the household can consider a fixed rate loan. Fixed rate loans can be a good option for households facing high interest rate because despite an increase in interest rate, they will always know how much the monthly payment that the household need to pay. For example, they can apply for a fixed rate loan for car financing or house financing. A fixed rate car financing and home financing is to protect the borrower's monthly payment amount from changes in interest rate or the condition of the economy. So this makes it possible for them to manage and arrange their car payments more efficiently over the duration of the loan. The last one is prioritizing debt repayment. Okay, you can save money on interest and eliminate your debt more quickly by making quick payment on your high interest debt. Therefore, they must make a list of all their debts after they establish a budget. And this include credit card, personal loan, student loan, and any other outstanding debt. For instance, if a family has a personal loan with a 10% interest rate and a loan on credit card with a 20% interest rate, they should prioritize paying off the credit card balance first. Whenever possible, household can make additional payment towards their debt. So as a conclusion, an increase in interest rates may have a significant impact on household. Increasing in interest rate can make it more challenging for household to pay their mortgage, their car loans, and other debts since they increase the cost of borrowing. This may result in monetary difficulty and in certain situations even foreclosure. So by implement this step to manage household finance during an interest rate increase, households are able to endure the storm of rising interest rate and eventually become financially stable. That's all from me. Thank you.